Well, good morning, everybody. Welcome to Friday. Thank you for spending some time with Jack and I. Just wanted to do a follow-up on the State of the Union. Markets rallied back to a very, very interesting point right here, right now. I'll just start with that. Again, these presentations are pretty free form. I'm going to drag a chart over for you right now just to set the stage as to where we are sitting. Do this. Try to go to that screen to do it correctly. There, focus. All right, so you can see that this is the S&P 500 largest companies in America. This is where we are sitting right today at under 5,500 on the S&P 500. That's a very important number because it was right at this point, right here, I guess, 2 weeks ago, 3 weeks ago, when Donald Trump announced aggressive global tariffs that the market was not expecting, and the market in 2 days fell about 10%. I will tell you, ironically, I've said this over and over again, you buy page 14, you sell page 1. What that means is whatever is on the front page of the news, do the opposite. And on this point right here, I got a call from CP24, and I was back on television for a State of the Union address to Torontonians. And the last time I was on CP24 was literally in the middle of COVID. And weeks later, the market took off, and we made a lot of money that year. So this was when I was on television. This is the Monday. The market went down and came right back and sort of closed where it was on Friday. And then since then has worked its way higher in about 2 weeks by about 10%. So we regained what we lost, which takes us to a bit of a crossroads right here. This is a very important number. It's a pseudo line in the sand, otherwise known as resistance. And things need to get resolved in the real world for the market to work its way higher. Trade relations need to be further de-escalated for the market to move higher. That will occur in due course. In our presentation, I have another chart I will show you. It's a similar chart, but that's the way I want to set up the backdrop. So we've recovered significantly, and we continue to hold good quality companies, et cetera, et cetera. This is a cute little piece here, the seven steps of maximum pressure. Playing around with Donald Trump. You can read this at your leisure. But this shows you the craziness that we've all been dealing with. This is a cute piece that we came across the other day. So I just wanted to share it with you. Bit of a roadmap. Back to COVID. The blue line is COVID. It's the S&P 500 index. Percentage change. With the red line being the present market environment. And I've seen these charts many times. This is done by Bespoke. They always like to look at historic charts to see if there's some kind of correlation, resemblance, pattern, and do an overlay. The red line will not follow through the blue line, but it gives you an indication of what could happen. So we should not be surprised if the market comes under further pressure, as it did in COVID. It had a recovery, then it pulled back, up, down, and then it found base and ultimately went higher. So we could be in for some more weakness. We have to prepare ourselves for that. It will be temporary if it comes. It's all part of forming a bottom. Tests of the retests of previous lows often occur. Some believe they always occur. That's actually not true. But we have to be aware. We're still slugging through this period, but it will end. And there is some green shoots and some optimism. It's all about less bad news, rate of change, de-escalation, and verbiage coming out of the White House. But the next few months can be tough. May tends to be a ominous period. Certainly the August to October period tends to be a little weak. So again, we have to be prepared for some more temporary setbacks. Again, I'm not saying that's going to happen. Just prepare ourselves, that's all. Corrections happen all the time. We know that. Again, just a different way of looking at it. If you look at your returns, any client's been with us for 20 years. Every 4 years, we don't make money. And the other 3, we do. So it's just very typical. The markets are negative territory once every 3, once every 4 years. for anywhere from 6 months to 18 months. And then they rally anywhere from 18 months to 48 months, give or take, go up. So corrections happen a third of the time, the one that we're in right now, and the end. Here is the S&P 500. This is from Fidelity. Jack and I went to a couple of amazing presentations with our partner Fidelity. Lots of intellectual capital inside that firm, and very, very helpful. I left you the whole report. I'm not going to go through the whole report in the interest of your time. I do encourage you to read it, certainly for the students of the market. There's some good material here for you to digest. If you don't want to read it, not a problem. But this chart here is important. It's a 2-year chart of the S&P 500. Once again, you can see the trajectory of the market, the way it ebbs and flows. Here is a little bit of a recession induced by the COVID.
High interest rates.
Excuse me, that was rate correct. 21 was COVID. High interest rates. That's when rates began to rise. Market went down. Interest rates go up, bonds go down, and that's exactly what happened in here. S&P 500 obviously worked higher to 6,000. Then it went down to 4,800 recently. So this most recent correction that we are currently in was greater than a 20% correction, which is considered a bear market. It's now back through that. It's now down 8%. So it's no longer in a bear market. But it was swift. It was quick. And this is that resistance line I am referring to. Right here is where Trump announced global tariffs well beyond what the market expected. We are now back at resistance line. So we went from 4,800 back to 5,400, right now 5,500. I did a lot of trimming this morning. So I used today as an opportunity to do a little portfolio rebalancing. I made one switch in the Canadian portfolio. That's the TSX quant portfolio. I sold Gildan Activewear because it's obviously they make underwear, and they too would be subjected to tariffs. They sell back into America, of course. And I think the company will be fine. It's a great company. It's a cheap company, but I don't need to own it. I don't need to own anything. So I sold Gildan and we bought Kinaxis. Kinaxis is a Canadian software company that deals with logistics, just-in-time inventory, supply management. And this is a supply shock that is taking place. So anything was to do with helping supply is a plus, I believe. So we made a switch in Canada. The United States, I trimmed today, just trimmed Bank of America, Google, Apple, Amazon, Meta. I sold those positions in half, still holding half because they're weak. They're very good companies, but right now they're not trending. I think they'll be fine. I think they'll turn higher, but other stuff is working. And so I put into Cadence Design. It's a software company for semiconductors. Again, onshoring of semiconductors. You have to design factories and equipment. That's what Cadence does. Copart is an online automotive auction center, used cars. Again, tariffs, bad for new cars. Tariffs help the used car market. O'Reilly Automotive is an auto parts company. It's working. So used car parts are working. Got a little piece there. Cintas Uniform Company, owned it before. It's a very predictable company, a very, very capital efficient company. It's a Fortune 500 high quality business. We bought some Darden restaurants. They own the Olive Tree. So people aren't traveling. They want to have a little staycation. They go to the Olive Tree, I guess. Olive Garden? Yeah. Olive Garden. Did I say Olive Tree? Olive Garden, thank you. We bought a electronic manufacturer to build circuits. This electronic contract manufacturing. The space is waking up again. Celestica came out with results that look better. There was another one that came out with results in the same space. And the space looks better. We have very little healthcare, so we came back to Eli Lilly with a small position. We have very little ag. If the tariffs are going to hit the fertilizers and the farmers, buying domestically is encouraged by American farmers. So we bought some Bunge as a chemical company, mainly for farming. And we bought some Domino's Pizza. I hate the product. I don't like their Olive Garden either. I don't like either, but I'm a food snob. But the stock looks good. The chart looks good, and it's screening well on my quant screens. All this was done in our quant portfolio. Again, that's much more process-driven, less gray matter, less personal biases involved. And that portfolio, by the way, is beating the index 2-1. The S&P is down, call it 7 on the year. Our quant's down 3. Our Canadian quant is up 4 and the Canadian market's actually down 1/3%. So we are very pleased with our performance. We got those numbers attached as well in the presentation. So I repeat, we are at a point of resistance. The market could stall here. It can get back a little bit. If it gets through this 5,500 with formidable strength, I think it's game on again, and it'll be a risk-on environment. It's to be respected. If people have been sitting in cash and looking for a chance to get in, if you're in cash, I'd be buying. I'd be long. I am long. All of my money is invested. All of our clients' money is invested. We got 3 people, I think, who decide to go to cash, and getting back in is the hardest part of that trade. If you sell, you got to buy. You got to get both right to make it worthwhile. And I think one of the I know the reason that we've had such a good relative performance year, and that we participated on the reversal to the upside, is because I've done nothing. Best thing I ever did, do nothing. Doing nothing is doing something. It truly is. Getting caught and trying to change strategy in the middle of a poop fest. I had to pause for that one. I don't think it makes any sense. Things have stabilized. I can do some repositioning now on my terms because we own everything. It's ours. We don't need to sell on the market's terms. We can do stuff on our terms.
The other thing I would just add in there, talking about the market stabilizing, it's not just about the equity market rising. Over the last couple of weeks, we were talking about asset correlations, and Wolfgang and I were looking at them, and normal asset correlations, they weren't making sense. So stocks were going down at the same time that bonds were going down and the US dollar was going down. So those things don't typically happen in a normal market. We're starting to see signs of normal market correlations now. So today, the stock market is slightly down. The bond market is slightly up. That's a normal asset correlation. And you see the US dollar today actually appreciating in a period of stress. So Donald Trump, I think, pushed the system too far. I think that's very clear. He overplayed his hand. Now that he's backing off some of that and de-escalating, you're starting to see normal asset correlations, whether it's stocks, bonds, gold. All the normal traditional asset classes are behaving as they should in a risk-on or risk-off environment.
I'll add to that since Jack brings it up, and it is complicated, and it's Friday morning, so I apologize for that. But if I just ask for a bit of mental muscle here to follow the bouncing ball. When stocks go up, bonds usually go down, because when stocks go up, that means there's economic activity and signs of overheating economy gets interest rates pushed higher. When interest rates go up, bonds go down. So I repeat, when stocks are going up, bonds normally go down. And that's why having stocks and bonds in a portfolio counterbalance each other out over time and smoothes your return. Stocks go down, bonds usually go up. And when stocks in the States go up, the US dollar usually goes down a little bit. When stocks go up, gold usually, Jack?
I would say it goes down. Yeah.
I would say it goes down. Yeah. When stocks go up, Bitcoin goes up, which is a bit of a weird one. What has happened this past 3 weeks, stocks went up, bonds went up at the same time. That shouldn't happen. And that's where Jack was saying this market's not acting normally. And he was dead right. It was a great observation that he made. And the reason being is you're getting a relief rally in the stock market. I think the stock market was discounting the future once again quite well, that this will get resolved. And it's going to get resolved when Donald Trump opens up the bond quote screen and revisits the bond market. And that's exactly what he did. He's a real estate guy. He understands debt payments and interest payments. And so in America, the number is, I haven't, Jack thinks it's 7 to 9 trillion. I was told it's 1 trillion. Let's just say it's a very big number. And America has about $30 trillion of outstanding treasury debt. That's $30 trillion. Coming due this year is a lot of it. I've heard a huge range of numbers, but let's just say it's 25% of that debt's coming due this year. I'm not certain if it is. 1/100th of a percent, 1/100th of 1%, it's called a basis point, change in interest rates on the debt coming due could be $1 billion either way. So if interest rates fall by 1/100th of a percent, America saves $1 billion. If he can knock rates down by a full 1%, i.e. he being Donald Trump, he could save the administration upwards of $100 billion, which becomes real money. He created an economic crisis that spoke of economic weakness that allowed interest rates to fall and bonds go up. But then inflation was sniffed out, and that stopped the Fed from lowering interest rates. And Trump then saying he's thinking of firing the Fed, which caused global uncertainty around the administration's relationship with the central bank, which is supposed to be independent. And that is so important. If it is no longer independent, the global financial community cannot trust America. And it voted with its feet, the global community at the margin. Japan specifically sold US treasuries a few weeks ago. When they sell bonds, that pushes rates higher and the price of bond lower because they're supplying the market with paper. So I repeat, when the Japanese sold US treasuries, that pushed interest rates up. That got Trump to stop in his tracks and said, I looked at the bond market and it was looking beautiful. It went not beautiful, but it's beautiful again. Yes, it was beautiful again because he put a pause on tariffs. It's a beautiful bond market. It's hard to read. Not many people can.
I say net over the last couple of weeks, traditional safe haven assets were not acting as traditional safe haven assets. Now that is being restored, and part of that is just with time and de-escalation.
Well, safe haven asset US dollar not acting well. Safe haven asset US bonds didn't act well. Gold safe haven asset, best performing asset class this year. We do have some gold, by the way, and I do think it's getting long in the tooth big time. But we have gold stocks that are up significantly more than the commodity itself, specifically Agnico Eagle and Kinross. And I probably just jinxed those. I'll show you just the portfolio live on your screen. At the bottom is the indexes. Here's the TSX index year to date, the Dow, the NASDAQ, and the S&P 500. Here's our portfolios today. Here's the market change today. So we pay attention to this all the time. We're making a little money today. The market's down. I'll take it.
The one thing I'll add just with those portfolios, Wolf and everyone, the performance there and that you're seeing on the indexes, often with our portfolios, like our growth mandate specifically and balanced conservative, they have a lot of US assets and they're reported in Canadian dollars. So yeah, as an asset class, the US dollar has been weak just for this year, about off 3%. So it has been a drag on our portfolios. We don't see it as a permanent impairment. And we also see the underlying equities in those portfolios doing just as well, if not better than their benchmarks. 1998,
I remember this sell-off very, very well. And this, again, the extrapolating data. The 1998 was an Asian contagion. I remember, again, dating my wife, Kathleen, took a trip to Newfoundland. If you haven't been to Newfoundland, you should go. It's a beautiful part of Canada. And I remember being in St. John's. There was a legal convention, and the market was going through a major correction. It was default, Asian contagion, et cetera. And all the lawyers were looking at their portfolios and getting quite concerned. I was not in the business. I was soon to enter the business, but I was invested. So I owned mutual funds back then, quite a bit of them, and I was feeling some pain. And it was amazing how if you look at a long-term chart, that period of time, just living through it, it was very, very painful. Once again, the blue line is the market back in 1998, where it corrected. It came into resistance. It sold back off, and then it rallied. Now, sell here, buy here, as you can see, easier said than done with
in reality.
Well, we're looking through a rear view mirror. Hindsight is perfect. But we are back at a point of resistance. As I said, that called this 5,500 today. I do see perhaps a stall. If it breaks out, you get a retest. That's called a retest right there, and it holds, and then it takes off. So here we are today. It's going to do some meandering. Ultimately, I do believe it's going to go higher. I'm dare not going to get cute trying to sell here and buy here. That is not enough money to play with. You're talking 12% to 20. Good luck selling down 12, buying. It won't happen. I won't be able to pull it off. What I did do here is rebalance the portfolio a little bit, as I discussed with you earlier. We took a little beta out of the portfolio, bought a few more defensive names. Just a little tweak, minor adjustment. Again, that's in the quant model, and that's what the process is telling us to do. So I've done nothing for 60 days, which is the best thing we did. But I did indicate in my last call that we do have changes we have to make. I want calmer waters to make my changes. That occurred today.
The other thing I would add just there, everyone, just talking to clients, and I have been reaching out as best I can just to talk to everyone individually. A lot of the commentary is, this is different, it's historic, it's unprecedented. 1998, at the time, people would have been saying the same thing. So the catalyst is different this time, I do agree. And every crisis, every crash, every correction is different. People's behavior and reaction to it tends to be very similar. And that's what I'm seeing when I'm talking to clients.
And I'm going to repeat what Jack just said because it's so important. It's always different this time. It needs to be different to knock it down as hard as it gets knocked down. So the story is different. Even the participants and characters can be different, i.e. you and I. But the way we as people act is always the same. They buy greed, they sell fear. Ultimately, we should do the opposite, or during periods of fear, do nothing, or buy, but do not sell fear. It never tends to be a prudent move. So here's our growth portfolio in Canadian dollars as of this morning. 80% of this portfolio is U.S. stocks. You have to be aware of that. So in Canadian dollars, it's down 8%. The Canadian dollar is up 4% since January 1st. In U.S. dollars, it's down 4%. And again, the S&P is down 7, the Nasdaq's down 12. So that's our growth portfolio. There's our balanced portfolio in Canadian. It's about 50% U.S. So it's probably actually down about 2.5 in U.S. dollars. Doesn't matter. It's down 5. There's conservative down a couple points. No big deal. Our mutual fund portfolios, which are doing very, very well, as well as the 4 managers that Jack has been closely monitoring. For smaller accounts, they're doing very, very well. It's great managers. It's the most expensive portfolio fee-wise, but they're earning their fee. They're doing a great job. Here's our Canadian quant strategy. And again, the Canadian market is down 1/3%. This thing's actually up this year, so I'm very happy with that. That's the stock. That's a portfolio today where we sold, Gildan, and bought Kinaxis. And again, if you don't have this portfolio, it certainly is a nice little portfolio. 15 quality Canadian companies. They're hard to find. Here's Guardian. I gave them. It's a third-party manager. I gave them a little bit of my money just to see how they're performing. Not bad. So it's a manager I'm paying for personally. Morgan Stanley, another manager that we've been encouraging you to start to look at. It's a global portfolio. This is in U.S. dollars, so it's down 5. I've given it a significant amount of my money. And AGF, same thing, global portfolio, third-party manager. I've given them some of my money. I think both AGF and Morgan Stanley will do very, very well. And I'm going to go back to all of our portfolios, everyone, our mutual funds, our third-party managers, the portfolios we manage ourselves, all of them, I believe, will do very well in the next 10 years if we stick to process. That is key to it all. If you're a value manager and you stick to your knitting, you'll make money. If you're a momentum manager and you stick to your knitting, you'll make money. If your momentum is going to stick to your knitting, but to keep changing and changing and changing and changing, that is how you take a nice hard bar of soap and you wet it and you make suds and it gets smaller. A portfolio is like a bar of soap. The more you touch it, the smaller it gets. And I have to eat those words. I have to remind myself about that all the time. So we have to, know when to hold them, know when to fold. And we got to do the counting when the dealer's done. So that's AGF. Here's our S&P quant. Again, the S&P is down 7. We're down 3. That's pretty darn good. So we're getting downside protection, thank goodness, and upside performance. So that is the portfolios for you. I'll get back to. I did, by the way, in this portfolio or in this presentation, resend to you this memo from Howard Marks. I sent it out about 3 weeks ago. The headline is excellent. Nobody knows. Yet again, we didn't know COVID. We didn't know financial crisis. Aging. How do we get out of it? We don't know. Ultimately, the world figures a way to get out. The invisible hand, market forces, the power of money finding a welcoming home always exist, and money has to go somewhere. Stocks, bonds, cash, gold, somewhere it's going to go. And as Jim Cramer says, there's a bull market somewhere. I'm always going to find it. He says, not me. But nobody knows. And when I read through this, the summary is, if you don't know, what is most probable and logical. And that's what gave me comfort. Howard Marks is a genius, but the way he summed it up, I think, is even more brilliant. Common sense, what's the logical outcome? Is it logical to bet against America? No. Is Microsoft going to go out of business? No. Flip it around. Do I think Microsoft will sell more software packages next year? Yeah. And the year after, etc. So that's logical to me. And that's why we did nothing. Logically, we own good businesses. Logically, the storm will end. And logically, good businesses that grow sales tend to make more money. And if they make more money, stocks go higher. So I encourage you to read this report. Nobody knows yet again. I'll come back to our slide deck from Fidelity. This is a great report too. You could read through it. You'll enjoy it. A lot of numbers here, how much markets fall during bear markets. Call it anywhere between 20 and 50%. That is the number. I'm going to share with you some somber news too. Earnings on the market every year and how much the market makes, blah, blah, blah. You don't need to worry about that. Other than, look, in this green line here, the market was making about, what, $65 a quarter. S&P 500 is estimated to make about $270 this year. So if the index is 5,400, you divide it by 270, and you come up with about a PE ratio of 20, give or take. If it makes 300 this year, which it won't, you get a PE ratio right now of about 16. So we're sort of in that 15 to 20 rate in terms of PE. Truth is, price doesn't really matter when it comes to stocks in general. Companies that make more money, the share price goes up. But valuations can swing around from PE ratios of 10 to PE ratios of 40. And they're not a really good predictor of future outcomes. It's been proven over and over again, as hard as it is to believe. So it's sort of contradicting itself. But when things are strong, you want to be long, and when things are weak, you got to sort of be defensive or sort of bury your head in the sand for a little while. It's not a bad thing to do either. Again, here's the Mag 7. This is the biggest stocks on the board. That's what's driven the broad market. You take those out, 7 companies, market's actually a lot cheaper, but it doesn't matter. Again, I go back to money flows and sentiment matter a lot more. Money has left America. It's gone to Europe. We know that. It's gone to emerging markets a little bit. We know that. The question is, the rate differential can only go on for so long. And once again, I think the rate differential between the two, the valuation differential, is narrowed. Why am I saying that? America is the strongest economy in the world. It is the most capital efficient economy in the world. And therefore, its stocks trade at a premium of about 20% to the world. They trade at a premium for a very good reason. American companies are better than German companies and Italian companies and Swiss companies and Spanish companies. If you dig into income statement balance sheets, it becomes quite evident. American companies have higher return on equity, higher return on capital. They are more able and comfortable to manage debt. Hard to say, but I'm talking companies, not government. They're good allocators of capital. The Japanese, for example, are very loyal to their people and to their suppliers. And so they don't cut bait the way Americans cut bait. You're fired is what Americans do. Japanese, let's talk about it. Let's meet next year about it. And they leave problems on their corporate structure. European companies are sort of in between, but again, return on equity much lower, not utilizing capital as efficiently as they could. A lot of legacy positions, less visibility. Not great, not bad business. I'm just saying relative to American companies. American companies are expensive for a reason. Anyway, with the money flowing into Europe, that has also narrowed the valuation differential. A guy from Fidelity said, I don't know how much more can be squeezed in that direction. I agree. Global earnings growth, it's going to come down with the probable recession that was self-inflicted by Donald Trump. If he wants to get a third term, Jack made the point very clearly the other day in the office. It was great. Do you want me to repeat that?
Go ahead.
I give Jack pop quizzes or whatever. He talks a lot. We all talk like gives me a lot of good ideas. Anyways, Jack's looking. If Trump wants to even have a notion of running for a third term, which he can't do, but It's Donald Trump. He thinks he can do what he wants. He'll have no chance on a weak market and a weak economy. He has to get this economy going. And the market said, dude, you're wrong. And he's finally waking up to the fact. Bassett is really pushing him. That's the secretary treasurer. And Elon Musk said, look, Donald Trump, I don't believe in tariffs. I think tariffs are bad. That's my opinion. You're the president. You're the leader of the people. You make your decision. But my opinion is bad move. And I said there's going to be a bit of a dissension between the two. There's no dissension per se, but they're not on the same page when it comes to tariffs.
And the market is telling them which one is correct.
100%.
Very much so.
So again, Fidelity, this is so funny. Fidelity, we're talking about making stuff from China back into America. I'm sure many of you have seen the Instagram memes out there. They're hilarious of American workers manufacturing, brassieres to cell phones, eating Dorito potato chips, sweating and moving afloat. It's funny stuff. The iPhone is manufactured today in China at a cost of $400. That iPhone sells in Canada or America for, call it, $1,000. There's a profit margin on that iPhone of about 55%. I was told by one pundit, if they made the iPhone in America, the cost to manufacture will go from $400 to $3,000. I was told from a different source that if they made that iPhone in America and they wanted to have the same profitability as they have making it in China, it would be a $45,000 cell phone. So either way, it's not going to get made in America. Further, to make that cell phone, you have to have a certain dexterity, and the Chinese manufacturers, people, because it's made by people, not robots. And that's the issue. It's too fine and delicate, apparently today, for robots to manufacture. So you need people with lenses on their head, magnifying glasses, and fingers that can operate with dexterity to put these little screws in, apparently. So that's why they're made by hand, and that's why it is preposterous to manufacture them in America. Denim jeans manufactured in Vietnam at $1.45 labor cost per hour, parlayed into American labor costs at $16.50 an hour, is beyond inflationary. It's absurd. So again, I ask, who's getting ripped off? The Americans because they're dumping goods into America at $1.50 an hour, or the Americans who are exploiting the Vietnamese labor at $1.50? The Americans, in my opinion, are getting a good deal as is. Tariffing it would be a terrible deal for everyone in America. So again, I think logic is going to prevail.
The other point that I would add there, especially with high value manufacturing, bringing it back to the U.S., he has given an exemption, he being Donald Trump, to electronics, to smartphones, to all that high valued manufacturing, and he's left the tariffs on, I'm going to say, commodity type products. So it doesn't even square with what he's trying to accomplish. So it doesn't make sense. And as Wolfgang was talking about before, when we're investing for clients, invest towards the most probable outcome. And obviously you have to adjust along the way based on given circumstances changing.
Yeah, there are, again, no sure things in this business. It's only probable, Wolf, you said this. Yes, based on the facts, based on probable outcome. No guarantees. But the probabilities are almost 100%. Based on history, 10 years out, market's higher. 20 years out, it is virtually a slam dunk. Markets outperform stocks, outperform bonds, outperform most commodities, including real estate. So,
and that's working off peak numbers for markets. We've actually just had a 20% correction, and we're down 10% off of the peak. So if you take a drawdown in a portfolio or in a stock market, your probabilities only increase of having a long-term favorable outcome.
And again, point to be repeated. The likelihood of making money after things are down is much greater than when things are up. When things are expensive, at some point, too many people on one side of the boat, what happens to the boat if you're a fisherman in a weak canoe? Mean reversion, probable outcome. Very, very important. That's too complicated. Here we are, the broad market. There's your trend line going back only 10 years for the stock market. Trend line was broken, but this is support. So these are just technical charts with lines in them. So 4,800 is a very important number. That is what we came down to. I said to one client, look, there is a chance the market pulls back to 4,400. That's another number I have in this sense, about 10% lower. It hasn't happened yet. Market has rallied back. This may never come back in. I don't know if it comes back in. I think if it does, it'll be temporary. So a low could be in. And in fact, we took a little bet in the office and probably be wrong, but we think the low's in. So I repeat, when should I get back in? Today, if you haven't, is my answer. This is important. Access to money, high yield credit spreads. Companies borrowing money below investment grade. When things get tough, their cost of capital, their interest rates skyrocketed. They specifically the financial crises. And it's a sign of weakness to come. Spreads in high credit or high yield did not blow out, and in fact are basically back to pretty normal levels. So the credit market is telling us, so far we're going to be okay. So far, more damage coming than more problem. But here, credit is telling us that the glass is half full, not half empty. That's important to pay attention to. Insider buying, insider selling. I don't pay a lot of attention to this chart. It's just in the package. But there has been some reasonable insider buying taking place lately. Again, insiders know their company better than most. They tend to buy well. I don't know about sell well, because they have to sell for various reasons, including tax purposes. But when they actually take their checkbook out and buy their own stock, that tends to be a pretty good sign. Speaking of, again, buying, again, I'm jumping around the place as Donald Trump would say, I'm going to do the weave, but you got to be very smart to do the weave and bring it back. With tariffs being pre-announced, a lot of companies have stocked inventory. They bought in advance of the tariffs. If we go into an economic slowdown, they may have to sell that inventory at depressed prices. And even if we don't go into an economic slowdown, when this whole tariff tantrum gets resolved, they may be deferring further purchases because they still have to work down their inventory. So the inventory stocking that has occurred presently could affect a few quarters of business activity. The market will likely read through that. We have to read through that as well. And again, example, in case Apple flying in airplanes loaded with iPhones. I don't know what the value is of one jumbo jet loaded up with iPhones. Must be a lot, but I think they took 3 or 4 planes out of China into America to get some inventory ahead of the tantrum.
The other thing that corporations are going to do in these times of uncertainty, and we all know they're very uncertain times right now, and just talking to the Fidelity analysts that we met with earlier in the week, when they don't know what to do with their capital and their cash flow on their balance sheet, so they're not going to be spending on plant and equipment and all those types of things, they're going to do something with their money. As Wolfgang mentioned, capital has to flow somewhere. They're going to be looking at, or they'll be incented to, buying back shares. They have cash flow. The market is on sale. Good corporate executives are efficient allocators of capital, and they will be reducing their share count, which is good for us as shareholders. It's not a full ballast on the portfolio, but it does provide some stabilization.
If you look at our report from last call, I think I gave you 10-year income statement balance sheet data on one piece of paper. On that sheet, and I think there's 10 companies mentioned. I think Apple was one of them. If you look at the bottom of it, it shows you the share count. And you can see a company like Apple, I think in the last decade, has reduced its share count by at least 25 or 35%. A lot of money. And so that in itself, if you have less shares outstanding, earnings per share go up automatically. And your ownership of the business goes up. So reducing share count is good. It is actually better than paying out a dividend, because if you pay out a dividend, the company has paid tax on that money. And then you, the shareholder, when you receive a dividend, pay tax again. It's double taxation of the dividend. It's a scam. And Warren Buffett has never paid out a dividend for that reason. He'd rather buy back his own stock when it's on sale. So share buybacks are good. US dollar high yield. This is actually very, very interesting. This is what an overlay and correlationship. Here's the price of money, 10-year treasury yield. Here's the date. So 10 years went, the 10-year treasury went to a 5% handle in 2 years ago, down to 3.7 to 4.7 to 3.6 to 4.8 to 3.6 to 4.5. And the US dollar basically followed suit. So as interest rates in the States go up, foreign capital comes to America. and pushes its dollar higher. All is good except that U.S. debt. I go back to this. The U.S. debt rolls over this year. Think of anyone who's holding a mortgage that's coming due this year. They're all hoping that the renewal rate will be lower, not higher. Donald Trump is thinking the same thing. He has a lot of debt coming due this year. They have to refi it, and they want to refi it at lower, not higher. The bond market said, guess what, buddy? You're a moron. Rates just went up. So he had to stop in his tracks because he knows what, I repeat, what 1/100% does to his cost of debt. If they can get interest rates down and the US dollar down, it'll be in good shape. They want the US, I'll tell you why they want the US dollar lower in America, for a few reasons. And the most important reason is foreign capital. He wants foreign companies to come back to America. If the US dollar is expensive, and I'm in Germany, I don't want to buy the US dollar when it's 110. If I'm in Switzerland, I don't want to buy the US dollar 110. If I'm in Ireland, where all those drug companies went to because of lower taxation, I don't want to pay 110 for the US buck. At par, it's better. So it's had a good correction to his advantage. But he spooked the bond market. The other point, a lot of the companies we own are multinational businesses. Microsoft, we don't own Microsoft, but Apple, Google, multinational businesses. They ultimately report their earnings in US dollars. So when they convert their euro back into US dollar at 99 cents versus 110, half their revenue has just gotten a 10% bump on currency. That's going to help us out. So there's going to be some positives coming to us. Donald Trump, by the way, has not given the market any good news, and it's coming. But he had to do some dirty work first, and of course, he has no idea what he's doing on that front either. And hopefully, the nonsense has abated somewhat. I think it has. But the good news is coming. That's tax reform and deregulation. He will juice the market. He does have some levers to pull. I just don't know if he understands the actual tools in the toolbox he has. But he does have, Bassett working with him. So bonds have stabilized. The dollar hasn't. Here's gold. Gold's been completely on fire. It is totally front page. Strongest asset class this year. How far it goes, I don't know. No one does. But there's the chart. We do own some gold stocks. Those gold stocks are going to be spitting out cash right now if gold can hold these levels. So it's a leverage play on gold. There's only gold stocks.
I say what we've seen as well, just over the last week with the gold stocks that have performed so exceptionally well, as you can see there. When the market does rebound, when you have these big up days, gold is actually selling off. Gold has been selling off the last couple of days.
Yeah.
On the big up days.
And gold and Bitcoin are related. They're not related. Which is, again, two funny asset classes unto themselves. This is a tricky one to read, but it's bond valuation and what a bond is worth. Inflation plus a little bit of risk premium is what you're supposed to get on a bond. We finally have positive yields again against inflation, which is good. But bonds do compete with stocks, and if interest rate, the higher rates go, the less attractive stocks become. So they have to get themselves reset. So you're getting less equity risk premium in the stock market today, which is not good news. Hopefully earnings can help solve that problem, and I think they will. Or rates have to come down, which I don't think they will a whole lot. So we have to be aware of this relationship. Inflation is your neutral target on inflation. I'm not going to go through that with you. This is probably the most important piece of paper I'm going to talk about today. Twilight for the secular bull market. There are two types of bull and bear markets. There is a long bull market, which goes on for decades, called a secular bull market. And then every 4 or 5 years, you get a cyclical bear market. And they come and go much quicker. When I began in this business in 2000, tech just began to roll over, and then the financial crisis kicked into gear. America went cold from basically 2000 to 2008. And then as it went cold, commodities woke up, and Canada woke up, and the loonie woke up. So the good news for Canadians is when the US goes for a nap for 10 years, which it will, it's just what happens, Canada should wake up. Should is the operative word. I don't think it'll be like the last one, but we will see. I've been paying a lot of attention to this for many reasons. But the target for the end of the secular bull market that we're currently in is towards the end of this decade, late innings of this decade. So 26, 27, 28, 29. 29 would be ominous. That'd be a 100-year anniversary of the great crash of 29. I don't know. But it's something I'm aware of. I'm paying a lot of attention to. We're getting closer to that point. It won't mean the end of the world. It won't mean the end of America. It just means money rotates in a grand fashion. And there's no guarantee it's going to happen. But read through this piece. It's very good. There's a little bit few too many lines on it to make it easy to read. But we are paying attention to it. And that's why I'm starting to look a little closer at Canada right now. I encourage you to put a little bit of your money in my TSX quant strategy. Because as it continues to improve and work, we can keep moving more money into for confirmation buys. But the America is so not dead. And I do think at the end of this presidential term, the market will be higher. I'll be shocked if president leaves office with the market down or flat. So I would even expect, from these levels, an 80% move up at the end of 4 years, I think is very reasonable. 50% would be fine too. I have a mental calendar in my head. It's a 4-year calendar. I'm a prisoner, and I got a Sharpie. I put an X's 3 days, and I got 4 years to go. I'm 3 years but 9 months left on my term sentence with Trump. I'm sure we all feel the same way, but we'll get out of prison. Yeah, this is the CAP model. This talks to Kelper's asset pricing model. It's academic stuff. Talks about, again, the secular bull market, where we are. So stuff that you can pay. You can read a little bit. Happy to talk to you further about it if you're inclined. So on that note, we're much better this week than we were last week, and we're not through the nonsense, but we are in a position of stabilization. I repeat to what Jack said a week ago: stocks, bonds, currencies were not collectively acting normal. Today, they are. So improvement, and it's being reflected in stock prices. Earnings are coming in. I want to come back to that. Google reported earnings last night. Google reported earnings of sales of $90 billion in the quarter. Earnings per share were supposed to be $2. It made $2.80. Huge beat. The $2.80 is nice. It made $2.80 a share. That's great. But that number I don't care about. That happens automatically if you sell stuff. I'm a salesman at heart. I know the importance in business of top line revenue. It's everything, in my opinion. No top line revenue, your story will fizzle in time. If you make money through selling stuff, you figure out a way to give stuff to the shareholder. 90 billion in sales in a quarter is a billion advertising sales in a day. I used to sell advertising. Gary Slate sold CFRB and his standard broadcasting to CTV for $1 billion. He sold an advertising company of 50 radio stations for $1 billion. Google generates $1 billion in daily ad sales. Those are ginormous numbers. Those numbers don't go away any way quick, and they continue to grow sales. So when you own stuff like Google and Meta, and I trimmed Google today, by the way, to mention that, but I'm not trimming all of it. I bought some Domino's pizza. Again, I hate the product, but they sell a lot of pizza, and I bought Darden, Olive Garden. Not a big fan. They still give you all you can eat salad.
I've been there for a while.
Nor have I. So that's
it's more US.
I think they're out of Canada. I think they even pull out of Canada, but the stock's working. So we got small positions in those names. I start with a small position. If it works, I add to it. If it doesn't work, it's easy to cut. Diversity is very important, and quality, of course, is important. A steady hand is important, and of course, sticking to your plan. So I will conclude: if you're retired and if you're sticking to a 4 or 5% withdrawal rate, you can continue to withdraw even when the market is down significantly. If you're taking big lumpy sums out, you don't want to take out money when it is in this state. But I repeat, your plan that we've done for you allows for a 4 to 5% withdrawal rate at all times of the market. So you needn't worry about taking out a little bit of money when the market's down a lot. Because when it turns, it turns. And the only way to get the turn is to be there. And ultimately, my good friends, the only way to make money is to own stocks and bonds, of course, as well. I am doing some more research on some other product on the market. I am going to be speaking again with Fidelity. They have a alternative hedge fund. I am intrigued at it. I am going to have a meeting with them on that. I might start to put a little bit of my own money into just to see what it does. If it's reasonable, I can then offer it out to you. But we do keep our mind open at all times. The world is becoming more sophisticated. I'll tell you, in terms of artificial intelligence, again, totally impressed with the scale a company like Fidelity can have with so much money behind it. How are they using artificial intelligence? They're using artificial intelligence today to screen all the analyst research on any particular company to find the key characteristic that the market is paying attention to on a particular company. For example, when they use software, servers, AI algos to read all this information to look for one repetitive word in each analyst report. And what they found, I think it was with Google or Meta or Apple, but Apple probably for sure, is China, China, China. That is the key attribute on Apple, is how its market share is improving or not in China. So earnings per share are important, sales are important, but to the analyst community, the fact that moves Apple is China. And so to be able to, and each company in each sector have different key attributes, KMPs they call them,
Key performance.
Key performance in their KPIs. They throw these acronyms in these meetings, and acronym. God, I can find, excuse me, what does that stand for? Anyone? Oh, no one knows, but stop and ask, what does the acronym mean? Oh, what's that all about? They explained it to us. Everyone's jaws just dropped. Very sophisticated. But again, Fidelity needs to do that because Fidelity, being a global company, has huge positions in these companies. In aggregate, they could own 20, 30% of a company. By regulation, they're not allowed to. So they have all these little independent companies that allow them to collectively buy all of these names. But that's a great example of how they are using artificial intelligence to help them make sound investment decisions. With that, I wish you a great weekend. Please, any financial tune-ups you want, call us. You want to come in and sit with us, the door is always open for you. And we have your back. We care about you. We're paying attention for you. You don't need to worry. You pay us to worry for you. I took a great trip to Vancouver, to Banff with my daughter and her friends. And boy, it helped. So take some time off if you need it, and enjoy your money. That's what it's for. And if you have any money on the sideline, it's a great time to put money to work. You'll be very happy in 4 years if you did some buying here in the middle of a crisis. You'll feel good about yourself as well. Final thoughts, Jack?
I just want to thank everyone for tuning in. It's important that we're able to get our message out to you. This is the most efficient way for us to do it at scale with our clients. If you have any questions, please reach out to us.
Thank you very much.